Our guest today is Carley Garner. Carley, thanks for taking time to be with us on Stock Shots this morning.
Thank you, James.
Carley, you stated in a recent article that economic growth and the economy are not necessarily related. Would you please explain that relationship for our viewers?
Sure. The stock market and the economy are two distinct entities. It's obvious that they're related in several aspects, but it isn't always clear which is leading which. For example, when retirement plans became popular in the 1980s, Wall Street enjoyed a long-lasting rally in which many economists are crediting to the robust economy spanning the previous two decades. However, this is contrary to the conventional understanding that it is a strong economy that allows stock prices to rise. In 5 of the previous 9 recessions, the S&P has actually ended the recession higher than it began. If you measure a year from the beginning of the recession, the figure actually becomes 6 of 9. The bottom line is that the stock market is forward-looking. Speculators aren't necessarily buying or selling because of information that we already know for certain, but they're trading about, on what may become in the future. In theory, a stock price is based on the present value of future earnings, and during times of economic downturns, firms are able to trim the fat, so to speak, and become more efficient profit centers. This potentially creates higher earnings and higher share prices despite the overall status of the economy. This makes it entirely possible for stocks to rise in a challenging economy and to fall during times of strong economic growth.
Well, I had listened to several guests that we've had that say the U.S. economy and the dollar are in serious trouble right now. What's your outlook on the domestic economy and the dollar?
Well, first of all, it's important to realize that economics is an art and not a science. Despite all of the data available, economists and policymakers are simply making an educated guess as to what the future really brings. Those with extreme views, whether positive or negative, tend to stand out in our minds because of the shocking message that they're relaying. There are always going to be optimists and there's always going to be pessimists. My goal is to be a realist. The biggest mistake that many investors or traders make is to become too bearish or too bullish. However, despite my efforts, I must admit that I lean toward optimism. It is obvious that the U.S. economy has fallen on tough times, but if history repeats itself, we shouldn't have anything to worry about. Comparing today's data and statistics with those experienced in the past, it's clear that we're simply spoiled. Our unemployment rate is moderate based on long-term standards. Inflation is here, but it's a fraction of what was experienced in previous decades, such as the 70s. We've seen better days, but we've also seen worse, and we were eventually able to prosper. As far as the U.S. currency goes, with the greenback being at or near all-time lows against all of the major currencies, it's painful now, but will eventually be one of the largest catalysts for domestic recovery. Currencies, like all other markets, are cyclical in nature, and in the long run, valuations are simply a product of supply and demand. With the dollar at such discounted levels, U.S.-backed investments and services will eventually lure buyers and drive the dollar higher. It's just a matter of time. However, picking an absolute top or bottom in a market isn't possible, but I definitely think that we're closer to a bottom in the dollar than we are a top. Long-term investors should eventually find value in the greenback at current levels.
Yeah, I have lost a lot of money recently trying to call a bottom. I got stung, particularly in the financials, trying to call a bottom.
It happens. We've all been there.
Hey, we've seen the markets accept oil at 100, 115, and 125 without a serious downturn, and that was very surprising to me. Is there a level on the price of oil that just scares money out of equities?
This is interesting because as crude oil surpassed $40 per barrel, Wall Street seemed to be completely focused on what was going on in the energy pit at the New York Mercantile Exchange, and all other fundamental factors were put on the back burner. However, investors, for whatever reason, became more comfortable with higher crude oil prices and interest seemed to fade. In fact, equities really didn't seem to react to the rally from $60 a barrel to $90, but, once again began to pay close attention once the benchmark $100 level was surpassed. Several well-respected investment firms and market analysts have predicted $150 crude, and I think that equities have priced in the possibility of this happening as well as the potential impact. While there's always going to be trepidation in buying equities with high energy prices, I don't expect a profound reaction on Wall Street. However, with that said, if 150 is reached, chatter of $200 oil becomes evident, seems like the market will begin to become susceptible to weakness. I mean, whether the difference between 150 and 200 will have a crippling effect on the economy is really irrelevant. What is relevant is common everyday investors could easily be frightened into selling their stock holdings.
Well, a recent guest told me that the markets can stay irrational longer than any of us can stay solvent. I have really started to keep that as something that I review every day, because I think that's very true. Mm-hmm. Is the market rational to accept oil at this level?
I think so. I think the fact that they're avoiding the panic reaction is somewhat rational. As hindering as oil prices are, we have yet to see a completely crippling effect on corporate profits. Painful and impossible are two distinctly different things. And right now, I believe that we're simply in the painful stage when it comes to energy prices. If the problem continues to spiral out of control, we will likely enter the impossible stage. Where this turning point lies exactly really depends on market psychology rather than mathematics, so it's difficult to pinpoint. But at that point, eventually there could be a tremendous reaction on Wall Street.
Volume lately has been pretty light. Do you make any adjustments to your strategies when volume is light?
My strategy of choice is option selling, and I tend to stick to markets that have high levels of liquidity, even during times such as this. As an option seller, I really don't make any drastic changes in my approach to the market or trading philosophy other than being more conservative in the positions that I'm willing to take or recommend to clients. In light volume environments, markets can sometimes make much larger and more dramatic moves than they may otherwise make. This is great for option sellers as long as they don't have a position on, but for those that are short premium ahead of a spike in volatility or a large price move, it can be very uncomfortable. So for this reason, option sellers should exercise additional patience before entering a trade. In my opinion, it's better to miss a profitable trade altogether than it is to be caught on the wrong side of a big market move.
What's your favorite market to trade?
I prefer trading stock indices and treasury futures. Both arenas offer excellent liquidity for both futures and options traders. We all agree that equity and fixed income markets can be extremely volatile, but the financial markets don't generally have the capacity to double or triple in value in a very short period of time, while commodity markets can and often do. For those that have an impeccable timing and an ability to pick a direction with certainty, commodity trading environment may be preferable. But for me, I try to approach the market without an overly strong directional bias, and this makes financial markets more appealing to my strategy.
Well, the upcoming election is providing us with a lot of uncertainty about the policies that we'll see over the next 4 years. Will the campaigning and what we hear off the campaign trail have much of an impact on the markets, and will you factor that into your trading?
Well, history suggests that the election itself gives the market a positive tilt. The Dow has managed to post several annual gains in excess of 15% during election years. In the past, most of the election year gains have been achieved in the third and fourth quarters. The explanation for this phenomenon is up for debate, and from a trader's point of view, it really doesn't matter. There's always going to be exceptions to the rules, of course, or times in which history has no influence on the future.
For the rest of this great interview, visit our website, www.stockshotz.tv. That's www.stockshotz.tv. Thank you for listening.